Every chart you've ever stared at was trying to tell you something. Most people never learn the language. They see noise, random green bars, random red ones. But the market isn't random. It leaves footprints, the same shapes over and over across every market, every time frame, for 100 years. This is the Chart Pattern Atlas. 12 shapes do most of the work. The bottoms, where trends are born. The tops, where they quietly die. And the pauses in between, where the smart money waits. But shapes alone aren't enough. 3 ideas make every pattern work. First, the neckline. The wall price has to break before anything is real. Second, volume. A breakout without volume is a bluff. Volume is the market telling you it means it. And third, the measured move. The size of the pattern tells you the size of the move that follows. The chart gives you a target before price ever gets there. Master those 3, and the 12 patterns stop being shapes to memorize and become moves you can see coming. Let's read the market. First, the bottoms, where downtrends die and new uptrends are born. 4 shapes, 1 shared tell, a low that refuses to go lower. The double bottom, the W. Price drops, bounces, then drops again, and stops at the same level. 2 failed attempts to go lower. That floor is real. When price closes back above the middle peak, the neckline, you're in. Stop under the second low. Target the height of the W, projected up. The inverse head and shoulders, the most trusted bottom there is. A low, a deeper low, the head, then a third low that's higher. Sellers are out of ammunition. The break above the neckline is your entry. Stop under the right shoulder, and the target is the head's depth measured up. The rounding bottom, the saucer. No drama, just a slow, smooth curve as sellers quietly hand the wheel to buyers over weeks. The quietest bottoms are often the most durable. Enter on the break of the rim and measure the depth of the bowl for your target. The bear trap. Price breaks below an obvious support, stops get hit, weak hands panic out, and then it snaps right back. The breakdown was the trap. The reclaim of support is your signal, and the people who just sold become the fuel for the move up. Now flip it. The tops, where uptrends quietly come to an end. Same logic, mirror image, and they form faster than bottoms, so respect them. The double top, the M. 2 pushes to the same high, and the second one fails. Buyers are spent. When price breaks the valley between the peaks, the top is confirmed. Short the break, stop above the highs, target the height, projected down. The head and shoulders top, a peak, a higher peak, the head, then a lower peak. The classic distribution top, where big money quietly sells to the crowd. The neckline break is the trigger, and it often comes back to kiss that line before it falls. The rounding top, the dome. The uptrend just rounds over. Momentum bleeds out slowly until the curve rolls into a downtrend. Less obvious than an M, but the message is the same. The buyers are gone. And the third family, continuation. These aren't reversals, they're pauses, the trend catching its breath before carrying on. For swing traders, this is where the cleanest setups live. The symmetrical triangle, the coil. Lower highs, higher lows, squeezing toward a point, pressure building. Volume dries up, and then it explodes, usually in the direction of the trend. Trade the break, target the widest part of the triangle. The ascending and descending triangle. 1 flat line, 1 sloping line. Ascending, a flat ceiling with rising lows, buyers leaning in, bullish. Descending is the mirror, a flat floor with falling highs, bearish. The flat side is where it breaks. The flag, a sharp move up, the pole, then a small tidy drift against it as the move rests. Then it goes again. Flags are fast and powerful. The second leg tends to match the length of the pole. The wedge, and here's the trick. Both lines slope the same way, squeezing together. A rising wedge usually breaks down. A falling wedge usually breaks up. The break goes against the slope. Watch for momentum fading inside it. The rectangle, the box. Price bounces between a flat floor and a flat ceiling, a holding pattern. You can trade the edges while it's range-bound, or wait for the decisive break and ride the trend that resumes. Here's the thread that ties all 12 together. Every one of these patterns gives you a target, for free. Measure the height of the pattern, project it from the breakout. That's your minimum objective. The chart hands you the destination before price ever arrives. So there it is. 12 shapes, 3 families, bottoms, tops, and the pauses in between. Master the neckline, respect volume, and let the measured move set your target. And a chart stops being noise. It becomes a story you can read. Which pattern do you trade the most? Tell me in the comments. Subscribe for the next one, and until then, trade the chart in front of you, not the one you wish you had.